Hello and welcome to the Business Standard Morning Show. I am Thirumay Banerjee and here's a look at the stories for the day. India is planning to take on China through its Production Linked Incentive or PLI scheme. This is what Union Finance Minister Nirmala Sitharaman said during her visit to the US last month. The government had rolled out the ambitious scheme in 2020 with an outlay of about Rs 2 lakh crore to make India a manufacturing powerhouse. But in the last fiscal year, it disbursed only 2,874 crore rupees or about 1.4% of the total outlay. So should it be a cause of worry? Maybe not, as the government has big plans ahead. So has this scheme been able to meet its projected goals? What are some of the challenges? Devargya Sanyal asks experts for a reality check.
Three years ago, in April 2020, the Union government introduced the PLI scheme for the large-scale electronics manufacturing sector. By the end of the year, the scheme had been expanded into a 2 trillion rupee scheme spread across 10 more sectors with an aim to make India a manufacturing powerhouse. Last week on April 26, the Department for Promotion of Industry and Internal Trade said the disbursement of incentives under the government's PLI scheme stood at 2,874 crore rupees in FY23. That's only 1.4% of the total projection.
Companies have invested about 51,200 crores in the last year and a half or so. This is only about a fifth of the 2.73 trillion investments committed by, I think, close to 600 companies selected for the incentives in an average period of less than 4 years. So if you look at the trend, it's barely par for the course of what was projected versus what's actually happening. Even if you look at the number of jobs that were actually created, the latest data shows it is only about 3 lakh jobs, as opposed to about 60 lakh jobs that are projected to come out of the scheme. Primarily, the reason for this is that only 2 schemes have reached the stipulated threshold, and that is mobile phones and pharmaceuticals.
PLI schemes for sectors such as mobile manufacturing, pharma, bulk drug, medical device, food processing, telecom and white goods have performed well. But sectors like textile, steel, solar photovoltaic module, battery and automotive have proved to be the laggards. Experts point to multiple factors, including geopolitical tensions that may have affected investment.
If you look at specific sectors like medical devices, textiles, automobile component manufacturing, they are actually struggling to find participants for the PLI scheme. The main reason for this is the low interest, is that most companies either do not meet the qualification norms for the scheme, or they feel that the return on investment is low compared to what the incentives announced for these schemes are.
Government sources point out that PLI schemes for respective sectors started at different points in time and are at different stages of progress. Incentive payouts usually peak only in the second and the third year for each scheme. Pending claims of 574 crore rupees are yet to be disbursed, and the claims are at different stages of approval. For instance, the 18,000 crore rupees incentive for batteries for electric vehicles is expected to kick in from FY25 when production will start. The PLI in textiles will also take off in FY25, whereas for steel, it is expected to start this year. As production increases, the government support increases. The disbursement of incentives is expected to triple to almost 8,083 crore rupees in this fiscal alone. Government sources, however, remain optimistic. According to the Union budget document, as of February 2023, 717 applications under all 14 schemes have been approved with an overall expected investment of around 2.74 trillion rupees. An investment of over 47,500 crore rupees and the generation of 4 lakh jobs have been reported across 12 schemes. Yet, major challenges persist across sectors, and even in better performing sectors like electronics. Many companies have found it difficult to meet their investment and production commitments to avail the PLI incentives.
The attention that we need now is in components that cut across all subsectors. We have a history of making them in India, but our scale, anywhere between 10 and 50% of our current use demand is being made in India, and anywhere between 50 and 90% is being imported. So I think it's a low-hanging fruit in my opinion. The manufacturing of these components that I mentioned will get us about 50-60% value add. Now this also translates into employment. So every 1 crore rupees of turnover, in my opinion, gets us one direct employee in the case of EMS. But the same in the case of a component is 1:5. So 5 people get employed for every 1 crore of turnover. Our request to the government always has been that let us get a PLI. Also, the gestation period of components is not as short as assemblies. So let us give them a PLI for not just 4 years, but maybe 8 years, 9 years.
Comes from two ways. One is actually looking at the scheme itself, modifying the scheme so as to enable more companies to be eligible for the incentives. But then I think differentiation, subsectors within the scheme, where you look at each individual sector, how that is, and then the government in general looking at how we push forward in R&D, new foundries, new cutting-edge technologies, which will then lead to more companies participating.
While stakeholders wait for a fillip in PLI numbers and production reaches full steam, some experts, including former RBI Governor Raghuram Rajan, remain skeptical. In a recent article on a social platform, the prominent economist argued that a deeper analysis and more detailed data on the PLI scheme's performance are necessary before it can be expanded.
But is PLI enough to lift the prospects of the country? What about productivity? What if a large number of company workers are turning up exhausted at its doors? A 2019 report had claimed that on an average, Indians spent close to 2 hours in daily office commute. And after the pandemic break, people have again hit the streets. While some cities offer comfortable and affordable mobility, others don't. A recent report titled Ease of Moving Index 2022 offered some insight into it. Tushar Verma takes us through it.
How many of us turn up fresh for work? Obviously, those lucky ones living close to offices stand a better chance. But most of us are not that fortunate. Cities are growing steadily, and with it, the travel time too. And long hours on roads are not just affecting productivity, but people's health too. While some Indian cities offered good public transport systems and better roads, which made travelling hassle-free, others did not. A recent report by Ola Mobility Institute, or OMI, titled Ease of Moving Index Report 2022, breaks down urban mobility on 9 broad parameters like affordable mobility and seamless mobility. The report analysed mobility in 40 cities, and more than 50,000 people responded to the survey, which formed the basis of the report. We look at 2 key parameters. Mobility spend is the share of household income spent on individual commute. The report analysed this using data of households with total monthly income less than 30,000 rupees. In cities with a population of less than 10 lakh people, Thiruvananthapuram and Cochin, both in Kerala, were top ranked in mobility spend. This means that people in these cities spend the least percentage of their total income on transport. In Thiruvananthapuram, the government has introduced a city circle bus service which has an option of day pass for Rs 50. In mega cities with a population of more than 40 lakhs, Kolkata and Hyderabad were top ranked in mobility spends. The report claimed that in New Delhi, commuters spent 10% of their total income on transportation. This is despite the state government providing free bus travel to women. So, what does this data tell us about the affordability of public transport in Indian cities?
Bus systems are backbone of affordable public transport in the city, which has a much wider coverage. So although a lot of cities are building metro, which is a good thing and which is only expand in the future, but till the time they expand and the cities find funds to make a network which is large enough, the buses will provide excellent coverage. And a very simple thumb rule that we use is you require about 50 buses for 1 lakh population. The reason why Bangalore survives still as a thriving job center, economic hub, is because of its excellent bus system, which is affordable. There are, I think, about 7,000 buses in Bangalore. So all your low income group, middle income group, even sometimes upper middle income group would use buses. Lot of the cities, like unlike Bangalore, which does not have a very good bus system, you will find that there are number of two-wheelers in them. Till the time your commute is 5 kilometers, 7 kilometers, no other public transport can really compete with the two-wheelers. But when your trip length becomes more than 10 kilometers, 11 or 12 kilometers, that is where the bus-based public transport will become attractive for a lot of people.
For most people, traveling to the workplace is time-consuming and requires to be adjusted in one's daily planning. The report says that time spent commuting has an opportunity cost which can be otherwise spent on productive activities. Among megacities, Surat and Ahmedabad are the only two cities where people reach their workplace within 30 minutes. New Delhi was ranked lowest, which means commuters took the highest amount of time to reach office in the capital city. Mumbai and Hyderabad were ranked poorly as well. So, what is the productivity loss because of this?
It's very important to consider transport externalities. Right, so being stuck in a jam, being exposed to noise, contributing to emissions, and also it has shown that travel in the night time or in the evening with a lot of exposure to traffic lights over a period of time, it causes a lot of problems, psychologically in terms of sleep and all of that. So all of these factors together do have a huge impact on health and hence quality of work and quality of life. So we have to look at public transport not in bits and pieces. It has to work in a system. Only when it works in a system, we can look at the affordability and the quality. So when we look at in terms of commute, we have to look at door to door. What we call is the door to door connectivity. So from the door of the house till the door of the office, or from the door of the office back to the house. So all the different modes that we are using, the whole chain of connections has to be looked at in order to understand both affordability and quality.
In the last 4 years, people have started using more public transport. 50% of all the cities surveyed reported a rise in its usage. However, at the same time, perception of affordability of public transport has decreased. The report has pointed out that as India strives to become a $5 trillion economy by 2025, our lighthouse cities need to demonstrate mobility traits which are second to none.
Mumbai Metro, meanwhile, has given a big relief to the residents of the country's financial capital. Moving on, the action of global central banks has been the key anchor for markets since last year. And as inflation begins to cool off across the globe, market watchers have raised bets in favor of an end to the monetary tightening. In this backdrop, will the US Fed Chief Jerome Powell deliver interest rate action on expected lines this week? Or will his dot plot outlook stoke fresh concerns? Nikita Vashisht and Rex Kano answer these questions in our next report. Market bulls gained muscle last week as India Inc.'s Q4 results showed the resilience of the Indian economy. The sentiment got a leg up on Friday when a weaker than expected Q1 GDP data in the US cemented bets that the US Fed could soon bring its rate cycle to a halt. Overall, the BSE Sensex index surged 2.4% during the week, while the Nifty 50 rallied 2.5%. The broader markets too witnessed a similar rally, with the mid-cap and small-cap indices advancing up to 2.6%. As we enter the holiday truncated week, the US Federal Reserve's interest rate action will be on investors' radar. While a 25 basis point rate hike is being seen as the likely outcome, Mark Matthews of Julius Baer believes that US Fed is coming to the end of the hiking cycle.
The futures market expects the Federal Reserve to raise rates by 25 basis points when it meets on the 3rd of May. Our forecast is for no more rate hikes because we think there's plenty of evidence that inflation is going to continue to come down. The U.S. economy is doing quite well, driven by consumption of services. But as we move into the second half of this year, the interest rate hikes that have already happened will start to bite, and the households will have depleted quite a bit of their savings. So we look for about a 50% chance of a recession in 2024. Much will depend on the Federal Reserve and if it wants to keep raising rates or not. The European Central Bank, on the other hand, is still going to raise rates by 75 basis points, in our opinion. Putting the two together, that should mean the dollar continues to come down. And that should also mean the dollar continues to come down versus Asian currencies like the rupee. The Reserve Bank of India, of course, recently went on hold, assessing the impact of its own rate hikes on the Indian economy. But beyond May, very few people do expect the Fed to continue raising rates, and that is the positive backdrop we see for currencies, especially the euro, but also the rupee.
According to Matthews, the US Fed will probably communicate about the end of the rate hike cycle without overtly promising so at the meeting. With the Reserve Bank of India already going for a pause, one last hike by the US Fed may not prompt it to follow suit. That said, the rest of the week will be guided by corporate earnings back home. Among the prominent ones, Ambuja Cements, Tata Steel, Adani Wilmar, Titan, Adani Enterprises, HDFC, Hero MotoCorp and Tata Power are slated to announce their Q4 numbers. Against this backdrop, what are the key levels that investors should track on the indices? According to technical charts, BSE Sensex may move in a range of 60,130 to 62,100, with support expected around 60,750 and resistance likely around 61,700. The Nifty 50, on the other hand, is likely to swing in the 17,700 to 18,350 range. The NSE benchmark could seek support around 17,850 and face resistance around 18,200. Markets are shut on Monday on account of Maharashtra Day. From markets, let us turn our focus to the corridors of politics. Rahul Gandhi recently got a respite from Patna High Court, which stayed proceedings in a lower court in connection with a defamation case filed against him for his alleged remark on the Modi surname. Gandhi had submitted that since he had already been convicted by a Surat court, he cannot be tried again in the same case. In legal terms, the court's decision is on the lines of doctrine of doubtful jeopardy. Raghav Agarwal explains more.
Double jeopardy is a doctrine which in most likelihood originated from the ancient Roman term non bis in idem, meaning not twice against the same. It is a procedural defense which prevents an accused from being tried for the same offense again after his conviction or acquittal. This doctrine is mentioned in the second clause of Article 20 of the Indian Constitution. It is a fundamental right guaranteed under Part 3 of the Constitution. The doctrine is also mentioned in Section 300 of the Code of Criminal Procedures or CRPC. But there are some conditions for the doctrine to be applicable. First, the person must be charged with an offence. Second, the investigation must have taken place before a judicial court or a tribunal. Third, the person must have been punished for his previous crime. And lastly, the previous crime must be related to the current crime. The doctrine exists in some form or the other in the United Kingdom, United States, Germany, and Japan. In the case of the US, however, the scope of the doctrine is wider as compared to India. There, a person cannot be tried in a court even when they have been acquitted earlier. In India, a person must be convicted in the first trial for double jeopardy to kick in during the second trial. In March, Rahul Gandhi was convicted by a Surat court for 2 years for his alleged comments on Modi's surname at a 2019 election rally in Karnataka. He was also disqualified as a member of parliament. Later in Patna, a defamation case was filed by BJP MP Sushil Modi against Gandhi for the same remarks. He accused Gandhi of hurting the sentiments of a community. As the remarks are the same, the doctrine of double jeopardy will be applicable in this case.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A constitutional bench of the Supreme Court too had unanimously upheld the doctrine in a 1953 case. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.